Good morning, everybody. Let's just start. We'll approve the minutes. I have no idea whether this constitutes a quorum or not. If it doesn't, we'll review them and approve them again next week. So somebody move to approve, somebody move second, and then the three of us.
I'll make a motion to approve the minutes.
Okay.
I'll second.
All right. Then all in favor? Aye.
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 Okay, so if that's legitimate, we'll approve it. If not, we'll do it again next time. So I'm going to just hand it right over to, I guess, Chris.
Great. Thanks, Todd. Good morning, everyone. Good to see folks. Trust you've had a nice summer. We'll be quick to our tasks today, just in terms of the layout before we bring the slide deck up. We'll do our customary review of the markets. We've got on the pension OPEB side a little bit of governance collateral to catch up with that relates to investment fees and liquidity in the plans. We'll catch up, obviously, on performance. It was a pretty good fiscal year for all the plans, which is always encouraging. And July actually has continued to be pretty good as well. And then we do have a potential action item for your consideration. There's been some issues with a couple of the fixed income managers that exist in the pension plan, which actually coincidentally overlaps with one of the selections Tyler has for participants on the DC side. So we'll talk you through those circumstances a little bit and what our thoughts are there in terms of potential courses of action on a go-forward basis. So with that, and always just jump in and interrupt us if you need to. Bear with me here. I thought I had this. Oh, there it is. I thought I had this thing all queued up here and ready to go. There it was. Get this. Folks can see that okay?
Good.
Yes.
Okay, great. It's probably a little late now, but anyways, Tyler and I will get reprimanded if we don't. If anyone wants to quickly come out to the end of the month to Chicago to our conference, you're more than welcome. Let us know. We'll get you signed up. A pretty good day of activities and speakers, and I think we've got, Tyler, a couple hundred clients coming to that now, right? So it should be a good day, but no, it's a little bit late in the cycle. In terms of capital market updates, we'll go through this a little bit quickly now that we're here in the autumn time frame, and a lot of this data, as you know, pertains to what happened through the end of June. But we can, again, as mentioned, we'll roll in a little bit what's gone on over the summer too. Really, the big picture takeaways as we kind of cross over the middle of the year into the back half of the year, as you all know, continues to be investors spending a lot of time thinking about and anticipating, thinking about inflation and anticipating what the Fed may do with rates. And you do see, as you've probably read, right, that inflation continues to be pretty well behaved. You see some of the visuals there in the upper right-hand corner of the page here, just in terms of the rollover in inflation and it coming back down to levels much more palatable to the Fed. The other thing we've talked about a little bit, as you know, and we continue to think it's an interesting case and probably front and center given the discussion we'll have around fixed, there are still very interesting opportunities in the bond markets from our standpoint. Those higher interest rates that we've talked about persist to an extent, and when they start to roll over, you can start to see some pretty compelling returns. You see in the lower left-hand corner of the page there, the aggregate index. It's that set of bars, third down from the top, and the broad fixed income markets where your portfolios are concentrated. You see there, it doesn't take a big move in interest rates down, the blue lines, to generate some pretty healthy price action and healthy total return. So just something to be mindful of because fixed income's been so frustrating for such an extended period of time. We do think on a go-forward basis, those returns will be more compelling and a bit more persistent in the direction that we'd like to see. And then finally, you've all read about it as well, of course, but certainly through June, we continue to have pretty concentrated returns in the equity markets, with the big AI names and the big tech names kind of leading the way once again through June anyways. Although, as we'll talk in a minute, that's turned over a little bit over the summer. And you see some of those concentration metrics in the lower right-hand corner of the page. We've always talked to you about the benefits, right, of being diversified from a global standpoint, from a capitalization standpoint, from a style standpoint. And those have been kind of penalizing stances, honestly, over the last couple of years. But over the summer, we've started to see a pretty dramatic turn, and we'll share with a couple numbers with you just to kind of restate the case, we think, in the importance of diversification in portfolios. A lot of data on this page, and won't go through it all in great detail, but if you remember in Warehouse, the idea that inflation is pretty well behaved. The other cover that the Fed has, if you will, is that the economy is solid and growing, but it's not perfect. So you see there in the upper left-hand corner of the page the slight reduction in the growth rates for GDP. You see unemployment rates in the upper right-hand corner of the page starting to move up a little bit. Actually, we referenced a 4.1% rate here. It spiked to 4.3% in the most recent reading just a couple weeks ago. Some of the survey data are the Purchasing Manager survey data, the lower left-hand corner of the page, indicative of a bit of a contraction potentially and a measure of weakness. And you see a little bit of a spike there in the lower right-hand corner of the page with some just consumer delinquencies and activity there. You put this all together, right? And it really has fueled the fire this summer. And everyone has every expectation, right, that the Fed will reduce rates come the fall. Right. And there's question now whether that'll be maybe even a 0.5% rate reduction as opposed to just 0.25%. And well-behaved inflation, and moreover, an economy that's not overheated, that likely won't have inflation spike with a rate reduction, has really gotten investors, excited for the prospects of Fed rate cuts. And certainly that's the way markets have been pricing as we come into the back half of the year. And then finally, just a couple of data points for you on the asset class return front. You'll see here, top half of the page. Again, this is data through June. Core bond there, you see third in from the left. Actually, a measure down through June, right, as rates kind of stayed high and even pressed a little bit higher. It's interesting in the third quarter, not on the screen here, but third quarter to date through, I think, Thursday night last week, bonds are up over 4% in the last 6-7 weeks. So you do see that recovery starting to take hold. And again, that's encouraging, as we talked about earlier, and expected, and we think it'll persist. And then finally, in the square in the middle of the page there, you see the gray bars, you see some of the global equity returns for both the second quarter and year to date. And we talked about that big spike in large cap names, in particular. Square in the middle of the page, they're up 14% through June. And again, not on the page, but just to the notion of some of the rotation we've seen. Quarter to date, again, the S&P is up about 2.6%. Small company names are up close to 8% over the last several weeks. And international stocks are up about 3.5%, a little north of that. So again, you're seeing other segments of the market outpace those large cap names in the US. And as we get this kind of the transition to a lower rate regime, perhaps we expect those kind of more diverse returns to persist, as I mentioned. So that's encouraging for sure. Let me stop there for a minute on the big picture stuff. See if there's any questions from the committee before we take a peek at the portfolios and performance. Anything from the group on big picture? Probably stuff that I think resonates with everyone now, but if not, jump in and stop us. So we'll forge ahead here on some returns. Governance this quarter on the pension side. We just want to, once a year, you'll remember, look at with a little bit more granularity the investment expenses that are being borne by the pension plans, and then just kind of a quick touch point on liquidity, just to make sure we're in good working order on both fronts. So the exhibit here pertains again to the pension plans, and you see front and center, right? The bulk of investment related expense for the plans, as you all know, is the managers themselves. So what we show you here is a weighted average investment expense across the pension plans. As you all know, right, they share the same manager roster and the same weightings generally. So their returns on that front, fees rather, are equivalent, and a little less than 0.5%, about 43 basis points, as you see there. Principal, the bank that does your custody work is about 2.5 basis points. So call it 45-ish for investment related expenses. And from our standpoint, we would offer the assurance to the committee that given the complexion of your programs, the size, the types of investing, active versus index and the like, we think that it's a very reasonable fee expense, all things considered, and very consistent with what we see across your peers statewide. So no concern on the investment expense front. And then from a liquidity standpoint, I'm going to jump here just quickly. You'll remember the only thing that isn't next day liquid in the pension plans is Barings, the core property fund that we've talked about in the past. We are encouraged, and we've seen actually a measure of stability in the real estate markets, and actually Barings has been outperforming pretty nicely the first 2 quarters of the year. So they, if you remember, were pretty conservative and early with some of their markdowns and property reappraisals. In fact, more aggressive, if you will, than many of their peers. That was a little bit of a headwind for them on a relative return basis, but now you're kind of seeing the pack, if you will, come back to them, and people have been more honest around price discovery on properties, and Barings now actually is stabilized and on a relative basis performing pretty well. So we'll keep you posted there. But the point being here, right, 95% of the portfolio, if we needed to, you could turn to cash the next day using the institutional mutual fund structure that's, the predominant vehicle that we use in your programs. So that is a quick take on governance. Again, I'm going to stop momentarily. Any questions from the committee on those 2 items? Pretty straightforward, I think, but just a good check-in for us, once a year and bookmark that so we're all on the same page. Looks like folks are okay. Great. All right. I mentioned earlier from a performance standpoint, numbers have been pretty good. And certainly it was a good fiscal year. If you look at we'll not go through each and every number with great granularity, but you see the 3 pension plans have earned somewhere on the order of 9 to 9.5% for the fiscal year ending in June. So obviously numbers, right, that are well north of the actuarial expectation, which is always encouraging. I wouldn't get too concerned. The 1-year relative numbers, a little bit of a shortfall. Some of that comes out of the fixed income managers, which we're going to talk about momentarily in terms of an action item. And then we've got a bit more small cap domestic equity in the program than maybe the broad markets and benchmarks. And again, as we mentioned earlier, right, you've started to see that turn. And I think those relative numbers have started to improve nicely. In fact, July was a very good month for all 3 of the plans. We were up about 2.5% in the month alone. So I think from a return and an allocation standpoint across the 3 plans, we're in pretty good shape. Again, we highlight here on the exhibit just for you to see MetWest and Western, where we've got some potential action items. So again, I'm going to stop for a minute, see if folks have any questions on pension returns or allocation before we spend a couple of minutes on the fixed income managers. Looks like folks are okay. Great. So you'll remember our research team re-underwrites your whole roster of managers every quarter, right? So they're having ongoing dialogue with their colleagues and counterparts at these different firms on your behalf, and talking about the process, talking about the team, assessing performance and the numbers, doing all the things you would expect that they would do. to keep a handle on the different managers that are running capital on your behalf. And we have had recent status changes to two of the managers in the pension plan program. One, Met West, has been moved to a terminate status by our investment research team. You might remember a while back, we talked maybe at our last meeting, there had been some changes to the portfolio management team, the backfilling, and the folks that were selected to take on new roles in the reconstituted effort. From our research team's honest perspective, there was a little bit of concern there in terms of their experience and their wherewithal and capabilities. And after a lot of, analytics and works and discussion with our investment committee, they did decide to move Met West to terminate. You'll remember that terminate status basically is our message to you, if you will, that we think there's a better, an opportunity to rotate capital to a higher conviction manager. So we'll talk about who that manager might be in just a second. Alongside that Met West status change, we actually had more recently a change to the Western status from to a watch status. Watch is if you remember, a situation where there are ongoing concerns from the research team, kind of a special level of due diligence and heightened attention. And they've been spending a good deal of the summer on that strategy, and some turnover at the team level, and a bit of concern there. And you'll remember, a watch status is one that we can live with a period of time, for sure, right? It gives us that wherewithal to continue to assess and monitor. Here's our challenge with Western. I don't know if folks read it or not, but last week, word came across the wires that the chief investment officer at Western was under an investigation from the Department of Labor for the way that the manager was allocating derivative trade outcomes across the big separate accounts that Western manages. That's different than the mutual fund you're in, but nonetheless related. And it was obviously not a very encouraging headline, as you can imagine, when the CIO is taking an immediate leave of absence, and there's a Wells notice and a DOL investigation. It obviously doesn't look good. That all culminates for us that, again, Western, while not technically on terminate just yet, we probably think it's time to rotate that capital to a different manager, a higher conviction manager in your pension plan. So those are the two statuses. I'm going to go quickly here, and we'll get into as much detail as the committee may like. What we've done, you may remember, is we catalog, obviously, and have a bench all the time, a bullpen of other good, capable fixed income managers. So what we've done, you can see on the page here, Western and Met West are the incumbent managers, and the recommendations from our research team as replacements. Hartford Bond is a strategy that's sub-advised by Wellington Asset Management out of Boston, who you may know, which is a large institutional manager, very credible, very capable. And then the other manager they do like in the space for diversified fixed income is Dodge & Cox Income. You see here just some detail. I won't go through all of this great granularity, but you see there as we kind of lay it out here, the type of work that our team does on how strong the portfolio managers are, how experienced they are, the philosophy and the process, how they build portfolios and making sure that's all on track, how they construct at a very detailed level those portfolios, how much interest rate risk they take, the fees associated with the effort, all the things you would expect them to do. The summary takeaway for the committee from all this data and information is that the Wellington strategy and the Dodge & Cox strategy check all the boxes from a due diligence standpoint. And I basically, this is an awfully busy page, I know, but you can see here, starting in the upper left-hand corner, we catalog historical returns to show you some comparison there, the said riskiness of returns, peer group rankings, whole host of data here. You do see, if you can very quickly scan the page, that both Dodge and Cox and the Hartford strategy perform pretty well and pretty competitively, and do so with experienced teams and reasonable fees. And basically on a summary takeaway basis here, I'm going to go back to one of the portfolios just so you can see it. We'll use the police plan here. Our recommendation to the committee is to swap out both Met West and Western in the programs in favor of Dodge and Cox and the Hartford Wellington strategy in the same sizes and configuration at the target level that we've got here. So no changes to the larger portfolio, but just new names, higher conviction names to execute within fixed income on your behalf. So I'm going to pause there because that's a whirlwind, I know. But we obviously are charged with staying in front of this stuff on your behalf. And as you know, we're pretty patient with managers. We don't swap managers in and out with great frequency, but on occasion, stuff rises to a level where we just think it's appropriate to recycle that capital. So our recommendation to you folks, again, is to swap out those two legacy managers for the new ones that we just mentioned.
So
I will, Todd, pause there and see what people think.
So we don't have Hartford and Dodge on any of our plans right now as managers?
We don't have them, Todd, in any of the plans now, no. These would be new managers for the pension plans.
And it's almost 30% of the assets that.
Yeah, it is, right? Because they both are, big core anchor assignments for you in the pensions. And it's unusual, right? Usually in fixed income, as you all can appreciate, it's kind of a lower key, kind of less action happening there maybe than in the equity arena. But we've just had kind of a set of circumstances here with a couple of these bedrock managers that are discouraging from our standpoint. And again, we think on a go forward basis, there are higher conviction names that we think would serve the pension plan's interest, more effectively.
It looks like it brings the expenses down a little bit too.
And it would, Todd. That's exactly right. I just going to mention that on the margin there, you have a couple basis point reduction in your aggregate fees, just given the way that the Hartford and Dodge and Cox price versus the two incumbents.
Yeah, I remember when you talked about Met West last time.
Yeah, Met West was, had a decent amount of rotation on the PM team, and we actually went to Los Angeles and visited with them. And the new folks, I'm sure, are very capable, right? We'll see, but they're relatively inexperienced versus who they replaced, and I think our due diligence team was a little concerned by that. The Western is more, situation is obviously fresher, if you will. And we've had a little bit of turnover. And then again, obviously the headline last week with the CIO is a disappointing one, right? It's just that's a tough optic, right, for an investment management firm when their CIO is as a DOL investigation looming. So didn't affect your portfolios directly, because you're in the institutional fund, but it's not a good look, right, when they're not allocating trades in a fully transparent manner in their big separate accounts.
And to piggyback on all this, we have Western in the defined contribution plan, so we typically may be a little bit more patient on a watch if it was just the DC plan that we're talking about, but we would probably want to align with the decision on the pension to make sure that you're aligning participant directed assets with the town assets. So we would probably make the same change on Western that we would, and most likely Dodge and Cox over the other, just to align closely with the pension side.
Yeah.
You'll remember it's a little different in the pensions, as you all know. So Tyler, like as he mentioned, right, an individual replacement for a participant who wants to make that selection. In the pension plans, as Todd mentioned, when we're getting up to 30% of the total, we're mindful of entity diversification too, right? Having 30% of the portfolio with a single manager, even in fixed income from our standpoint, is a bit of a stretch. So that's why we kind of recommend the two managers as kind of complementary selections there, and it helps control that entity exposure a little bit. So it's a little bit of a different animal on the pension side. versus what Tyler describes when you're building your lineup for participants, but obviously related and similar. And I think both actions would get you in good places.
I mean, it seems prudent. I'll see what Steve, Heather, Bert, Lisa have to say about it, and then we'll have to make sure the Board of Ed hears about this. But I think this ends up going to the Board of Finance to actually vote to change.
Yeah, I think that is the protocol, Todd, for sure.
I mean, it seems founded on research and insight, so I'm in support of it at this point, but I agree with the full disclosure to BOE and everyone else.
You know, it's interesting, right? So we obviously would encourage you to move away as soon as practical. And I say that because it's not a run for the hills thing, right? There are teams that are running the monies for you today. They're relatively experienced teams. They're tasked with the same framework to find you good fixed income opportunities to run the portfolio. So to your point, Steve, right? I think you're right. You can do it in an organized manner where we provide, an opportunity for other stakeholders to obviously weigh in here. I know the next Board of Finance meeting, I think, is September 17th.
Right.
And if the board, if this committee's insistent, we'll make it work on our side. We might have to do it remotely, and I think Todd mentioned he would prefer that to be an in-person thing. So, and that being said, right, full circle here, if it was the October Board of Finance meeting, I think we could be fine till then and get that that validation from that group before we actually moved on things, if that time frame suited this committee.
Let me check with Lisa. She's having internet issues, so she's kind of in and out. But if we can do virtual to speed it up, if the Board of Ed is okay with it as well, and Bert and Heather are okay with it, we recommend it.
Could I just ask,
Yeah.
are there any transaction costs or transition costs associated with changing the managers?
No, they're really not, right? Because you're just moving from institutional fund to institutional fund. There might be a $15 ticket fee, principal, but it's de minimis. There's nothing that should concern the committee.
Right. Todd can pay that.
And Bert, on the DC side, it's a little different. On the allocation side, you could just change it, but we would usually take 30 days to notify all participants that this would change, and then it would change overnight if people don't make any decisions. It's per ERISA. You want to follow that rule. Now, on the DC side, the Western asset makes up 1% of the entire pool, so it's a lot less, but still, we want to follow the protocols.
Can you guys hear me?
Yeah.
Thank you for that recommendation. Sorry about my internet. It still has not come back on. I think that Todd's analysis was right in terms of process. To the extent you want to expedite it, we could do it remotely in September, or if you think it needs to be done before then. I think technically the charter just requires us to consult with the Board of Ed and the Board of Selectmen, which we are doing today, even though the Board of Ed hasn't shown up. But I think Todd is right and Steve is right to let them know that this is being considered, even though they didn't show up. And we can do that by email, a phone call, or certainly invite them to the next meeting of the Board of Finance. My only question is, do we need to hold a special meeting sooner than that, or are you comfortable with the timeline of September 17th? We don't want to put any assets at risk by any delay.
Yeah, I think, Lisa, from our standpoint, September 17th would be perfectly fine and perfectly suitable. We don't have to have a special meeting in advance of that.
Okay. And Todd, I can coordinate with you offline about how best to notify the Board of Ed on that.
Okay.
We'll make a note of that for the record, and then we can obviously get you any collateral you need in advance of that meeting. We can put together a small packet to help support the conversation on the 17th.
Okay.
If I could, Mr. Chairman, just I know Tyler's chomping at the bit here, but just very, very quickly, just for the record, there's not a lot going on with OPEB, but it continues to be a very nice story there as well. So you see, just showing you the OPEB returns here. Remember, we're all indexed essentially on this side of the ledger, so the numbers kind of look like the broad markets as you see there through time, but a nice fiscal year, up a little north of 11%. You see the configuration of assets here at the end of June. In pretty good working order, so no wholesale concerns there from an allocation standpoint, and things kind of, aligning with expectation and constructive outcomes as well. So I will stop on my side of the ledger here. I'm all done, absent any other questions on pension or OPEB.
Sound like it. Thanks. Thanks very much, Chris.
Thanks, folks.
Thank you.
Okay,
Tyler, do you want me to bring up the screen for you, or are you going to do that? We can't hear you.
Sorry, can you hear me okay?
good now.
And also see the screen?
Yep.
Perfect. So our governance, our cadence throughout the year is slightly different, but if you remember, we spent some time looking at the fees last quarter, benchmark them to appropriateness. This quarter, we call it our investment focus quarter. We're obviously always reviewing the investments, but given that this is participant directed, we want to make sure the right types of funds are being offered. So let's benchmark those from a trend standpoint. Let's make sure that other plans have similar like funds. And then for some of the more unique investment options, like, your stable value, protection of principal options, and the default funds, which are target date funds, they're obviously a little bit more unique than your run-of-the-mill, large growth managers. Let's take a deeper dive into how those work, especially given that a lot of people gravitate towards those target date funds. So what you see here, obviously another a busy slide, but what this is just an outline of the investment menu for participant direction. So from left to right, on the left side, you have the target date funds througrough T. Rowe Price. And then the numbers below are the number of participants invested in those various investment options. And so you have the target date funds through T. Rowe Price. We have a capital preservation option through Mission Square. So it's a stable value investment option. Within fixed income, you have obviously that Western asset as our active manager, as well as a passively managed bond index fund through Fidelity. And then within the blue box, it's a sprinkling of both active and passive investment options. So we actually include index strategies within all the style boxes, as well as a complementary active manager option through MFS, T. Rowe, Vanguard, and even Vance. But Fidelity obviously is the index strategy. And then internationally, you have international passive or international index options and an option through Hartford. So the concept behind this when we built this menu is let's offer the target date funds for most individuals. Most people will gravitate towards the sort of dynamic fund that adjusts as you approach retirement. But then if someone wants to completely asset allocate using lowest cost index strategy, right, Fidelity index strategy, they can invest in fixed income, U.S. equity, international through that index construct, at 1.5, 2, 3, 4 basis points total. So someone could completely asset allocate using low cost. And then finally, for folks that believe in active managed outperformance, there's the capabilities for folks to invest in those actively managed investment options. So as you can see, the bottom line here is the total number of participants per each plan. You could see a lot of people gravitate towards the target date funds, either being a default fund or the fact that it adjusts automatically over time. Obviously capture a lot of the assets. And then I'd say large cap active and then large cap passive kind of round out the next highest, and maybe the stable value options. So some pretty good utilization. I think the newer options, when we did move plan systems, the Fidelity index strategies actually were the options that were newer, which is why you see less of the folks in those investment options, particularly in the value and growth space. But there isn't any that are significantly underutilized. I think they all serve a purpose. And then when we benchmark that that menu for, what the industry is doing, what we use here is Vanguard's How America Saves study. It just takes 1,000 plans and looks at what types of asset classes they're offering. So what this is showing you is 96% of plans like yours offer target date funds. And when they're offered, 83% of participants use those options or utilize those options. And so it aligns really well with the data I showed you previously. Again, you have the target date funds, and a big majority of folks are in those funds. The next highest is large cap active. From a utilization standpoint, that aligns exactly with what we're seeing in your plan. I can draw a 50% line right here, and you're offering the majority of the asset classes that are offered in a majority of retirement programs. There isn't an investment option like a high yield bond or a sector fund that you're offering that is in the minority. I guess one of note, we're seeing it's an increase, but socially responsible is only in 17%. That being said, that especially the non-for-profit space is definitely looking at adding these types of funds. So it helps us build menus out. It helps us make sure we're aligned. If you flash back 15, 20 years, target date funds would be non-existent. And so we want to make sure that the plan is looking at entertaining options that maybe starting to trend up. But overall, I think you're in the right space. I did include some slides around the target date funds. Just again, the concept behind all target date funds is they have what's called a glide path. So it's a decrease in stocks and increase in bonds over time. The idea is early career, you want to be more growth oriented. Later career towards retirement, you want to be more income oriented. And so the T. Rowe Price glide path is reflected here. So what you have is the allocation from equity to age, and then the building blocks of that allocation. And so you could see, early career, 25-year-old, primarily equity. You can see it's the makeup of it is large cap, mid cap, small cap, and international equities. As you get to that retirement date, right around 65, 67, T. Rowe starts to introduce more market risk and inflation risk assets. So TIPS, investment grade fixed income, non-US fixed income. And so that happens automatically. What looks like this now for a 25-year-old should, in theory, as a snapshot now in 40 years, look like this. And that's done, without the employee or the participant doing anything at all. The one thing we've had, lots of talks with Wyatt Lee, who runs that T. Rowe Price target date fund out of Baltimore. T. Rowe believes very strongly in this risk of longevity, the outliving of retirement. They've, over the years, realized that the data that goes into building a target date fund typically is how are people saving, how are they behaving, when do they retire, how long do they live in retirement. And T. Rowe realized that their original assumptions shifted a little bit. They assumed people were saving per year with an employer match or a profit sharing contribution 15%. The reality was closer to 12.5%. So they believe that there's an underfundedness there. They also saw over the last 20 years mortality change. People's mortality rates were actually a little longer, and so that was a concern. And then behavior, oddly enough, if target date fund investors were pulling out of the markets in points of volatility, it would defeat the purpose of having a target date fund. And they found that from a behavior standpoint, the people who are timing the markets much more were the sort of do-it-yourselfers, as opposed to the target date fund manager or target fund investors would just sort of hang tight and they wouldn't behave in a way that could be detrimental to the retirement plan. So what you see here is just a comparison of the equity positions across all of the target date funds in the industry. And what you'll note in red is T. Rowe Price. They clearly take on a little bit higher equity position than some of their peers. The what you're seeing here is the band is all of the target date fund managers. The dotted black line is the average of all the target date fund managers, and the blue is the average of the top three, which does actually include T. Rowe Price, but also Vanguard and Fidelity. And so you see that T. Rowe does take on higher equity position. We think it's through sound reasoning. We do believe in Wyatt's team, and they take on obviously a lot of that data and believe this longevity concern is a little bit higher than potential market risk and other things that could impact retirement.
So this is one fund that just changes its mix based on the age of the participant?
That's correct. Yeah. So what you're seeing here, and I'll show you performance in a moment, but like 2060 fund would look like this here. In 40 years, that 2060 fund is going to look like the 2025 fund, the 2020 fund. So it does that automatically without the participant doing anything at all. Rebalancing and all the things that go around are required or are important to asset allocation. That just happens automatically. The other thing I'll show you on the target date funds is we're showing it. So again, Todd, we call them vintages. So obviously it's the 2020, 25. It correlates with when the expected retirement, doesn't mean the required retirement, but the expected retirement of an employee. And what we're showing you here is the 4 different vintages across the industry. So 2020, 2030, 2040, 2050. And then plotted out is all of the managers in this industry from a risk to return standpoint. So further to the right on this on each graph here is more risk, standard deviation. Further on the vertical axis is return. And so what you're getting with T. Rowe Price, particularly in the 2030, 2040 funds, is slightly more risk, but you're getting the value for that risk. Obviously top performing return over that 5-year period. And I'll show you the 10-year in a moment. And oddly enough, in the 2040, 2050 plotted out, the T. Rowe is kind of moderate from a risk standpoint, but still getting you top decile return across the board. So, if we were down the bottom right part of this chart, be a little bit more concerned taking on that risk, not getting you value for that risk. But T. Rowe is getting you the return for that, clear high equity position across the comparative chart. Any questions so far on the target date funds? Really quickly, I did include, we offer stable value through Mission Square. Stable value is sort of a typically insurance-backed product that can go a little bit longer in duration to protect the principal. They invest in a pooled vehicle, and typically will pay anywhere from 2.5% to 3%, but doesn't align as well with the Fed rates and money market returns. And we think that's a good thing for the longer term, because we don't offer a money market, we offer this stable value vehicle. And I'll leave you with this chart here on 37. What you have is a comparison between stable value performance, rolling 12-month returns compared to money market funds. And this is going all the way back to 1989 here. And so the line here, the black line reflected here, is the rolling money market returns. Obviously, you see points in time with the Fed rates is a lot higher, and obviously points in time with the Fed rate was 0. What you get with stable value historically is an outperformance of money market over a 12-month period. But we are at that moment now where the rolling 12-month, obviously given where rates are, is outperforming the stable value. That being said, if we're as a retirement investment option, obviously thinking long term, you could see historically, when you look more at annualized return over a 10-year period, stable value outperforms that money market. Given we had a 6-year period of rates being 0, where stable value was paying 2.5%, 3%. So we are at that odd point right now with an inverted yield curve that we do have a higher paying money market over the last year, but we still do believe and recognize that the value for longer periods of time is that stable value option. Okay, so when we look at the balances, you can see the pool has moved from about 14.5 million to 17.5 million at the end of June. The bulk of the assets, and I know a lot of the participant investments were in the target date funds, but it's only about 19%. And in the target date funds, the next highest is the S&P, which, if you ask me what were the 3-4 largest allocations for most of my clients, it's target date funds, it's stable value, and it's the S&P 500, which is pretty much reflected here. The one thing you'll note, as I mentioned before, is that Western Asset Core, which we think Dodge and Cox would be a good fit to replace that. Obviously, Chris went through that already, but not as significant exposure that you have in the asset allocation. But obviously, we would really want to align those decisions from a fiduciary standpoint. The optics would be challenged if you made a decision on the pension assets and decided not to move forward with the defined contribution assets. And I think given that the Western Asset is on watch with obviously some new news that recently occurred, it may be just prudent to just make the change as we make the changes on the pension side. The Board of Ed reflected here, so up from 1.3 to 1.7, slightly more overweight in the target date funds. And then of course the 401A plan, much more overweight in target date funds, given that this more people will default in this vehicle. And so you have close to 90% of the assets in the target date funds, which that we don't have any concern with. We do like the target date funds. And when we get into performance here, you'll note, and we're a little different. We like color on the DC side, but you'll see we have the target date funds performance net of fees on a quarter, year to date, and then one annualized on a 1, 3, 5, and 10. The index it compares itself to, the peer median, given that particular vintage, and then the peer ranking. And as you can see reflected here is the T. Rowe Price retirement funds are, top decile, sometimes top performing fund over the last 5 years. You can visually see the glide path from a performance standpoint, given that, we all know how equities have done versus fixed income over the last 10 years, with obviously the less volatility, but the 2005 fund was up 5% per year, whereas, higher equity, higher position, or higher equity exposure, 8.6 annualized performance for say a 2060 fund. And I'll show you how that balances when we get to annualized performance as well. The Western Asset's the one on watch. I think, long-term still outperforming the index, but I think it's worth having the discussion around replacing that particular option and aligning it with the pension. The only other fund I'll mention, Vanguard. Yeah, go ahead.
So which would we replace Western Asset with?
Sorry. The Dodge and Cox, when we showed the performance, is just has outperformed the other. And I think what Chris was talking about is balancing your overall exposure across a couple managers. You don't necessarily need to do that on the DC side, given that it's just one mandate that we would be replacing. And you also have an index strategy there that could also counter the active managed fund. We have Vanguard Explorers on Discuss. The fund's still doing very well, aligned well with the index. They just the Discuss is just maybe a change of note that we want the committee to reflect on, and they're just they're changing out Cardinal Capital. So Vanguard Explorer is a sub-advised construct, so they have 3-4 managers that advise that portfolio. They're actually pulling out Cardinal Capital and putting more exposure to the Wellington group to advise on that, and that's just of note. No big concerns. They already had exposure to Wellington, And then if I'm not mistaken, you also had the Hartford International Ops on the pension side. We just have it on watch just because of the announcement of a portfolio manager's retirement, but no significant concerns and recommendations to change outside of the Western Fund. So I'll pause there and see if there's any questions of the committee. I mentioned that visually seeing the glide path. So obviously the 2005 fund, annualized over the last 10 years didn't do as well as the 2060 fund, given its equity exposure, but you could see in points of time of volatility, obviously 2022, 2018, they obviously don't underperform as much given their risk exposure approaching that sort of retirement date. So I'll stop there, see if there's any questions I can answer. Great. I'll pass it back to Todd.
Hey. Thank you, guys. Does anybody else have anything they want to discuss with the committee? What we'll do then is we'll work with Chris and Tyler to coordinate getting you guys, let's try virtual on the 17th to get this done as quickly as possible. And I guess I'll ask Steve and Heather, if you hear anything contrary to what we decided from the Board of Selectmen, let me or preferably Lisa know. And Lisa and I and Bert will make sure we contact Jeff and the Board of Ed folks to the extent that they have anything other than kind of agreement with what we've talked about here. Make sure that let you guys know. We'll plan on setting something up for the 17th to kind of make those changes to the managers, unless we hear something otherwise. But other than that, and nothing else. I don't know when the next meeting is, but take a
The
motion.
next meeting is December 3rd.
December 3rd. Okay. I'll take a motion to adjourn.
So moved, Bert?
Second.
Thanks. All in favor? Aye.
Aye.
Okay. Thank you, everyone, and have a great week.
Bye, folks. Thank you.
Thank you.
Bye.